Rezolve AI PLC, ticker symbol RZLV. As of the closing bell on Friday, November 21st, 2025, the stock is sitting at exactly $3 per share. The market is currently closed for the weekend, but that flat figure betrays the absolute chaos we witnessed during the last trading session. We saw the stock gap up significantly at the open, hitting highs of $3.18 before sellers stepped in to hammer it back down to the $3 mark, leaving us with a daily gain of just 0.33%. If you were looking at the one-week chart, you might see a stock that is just chopping sideways. But if you look deeper at the volume and the ferocious battle between the bid and the ask, you will see something else entirely. You will see a company that is currently the battleground for one of the most intense psychological wars in the small-cap AI sector. The expectation on the street, fueled by months of Reddit threads, short reports, and liquidity rumors, was that Rezolve AI was just another SPAC casualty waiting to file for bankruptcy. The narrative was simple: it's a cash-burning zombie. That was the expectation. The reality, however, just hit the wires, and it is forcing every single bear to sweat in their expensive office chairs. This company, which many wrote off as dead money, just posted first-half revenue of $6.3 million, beating consensus estimates by over $1 million, and reported a gross profit margin of 95.8%. You did not mishear that, 95.8%. That is not the margin of a struggling hardware company. That is the margin of a pure, scalable software powerhouse. They didn't just beat expectations, they obliterated the thesis that this business model doesn't work, and yet the stock is trading at $3. This creates a massive disconnect, a curiosity loop that we need to close right now. Why is a company that just raised its 2025 guidance to an exit rate of $150 million in annual recurring revenue trading at the price of a latte? Is this the opportunity of a lifetime? Or is the market seeing a trapdoor that the headline numbers are hiding? To understand this, we have to look at the psychology of the shareholders right now. If you go onto the message boards, the sentiment is fractured. You have one camp that is absolutely furious. These are the retail traders who bought in the $6, $8, or even $12 range earlier this year or last year. They have watched their equity evaporate, and every time the stock pops, they use it as an exit liquidity event because they have lost faith. They are tired. They are frustrated by the silence from management in previous months and the sheer volatility that makes holding the stock feel like riding a bull in a china shop. Then you have the new entrants, the contrarians. They are looking at the partnership announcements with Microsoft and Google, partnerships that aren't just logo slaps on a website, but involve actual co-selling agreements. And they're asking, how is the market missing this? These investors are excited, but cautiously so. They feel like they found a secret, but they're terrified that the crowd wisdom knows something they don't. Let's look at the data driving this emotion. Short interest is hovering around 10% of the float. That is high. It tells us that a significant amount of smart money is betting against Dan Wagner and his team. They are paying borrow fees of 5 to 8% just to keep their short positions open. When a stock reports a massive earnings beat and raises guidance, and the stock doesn't immediately double, it's usually because this short-selling pressure is capping the rally. We saw exactly that on Thursday and Friday. The news dropped, the stock surged 21% pre-market, and then boom, massive sell orders hit the tape, suppressing the price back down to the $3 mark. That is not retail selling, that is institutional defense. But here's where it gets interesting. We are seeing institutional accumulation happening quietly underneath the noise. Filings show that major players like Citadel and BlackRock have been adjusting their positions. While some are taking profits, others are opening new lines. This isn't a stock being ignored, it's a stock being fought over. The volume recently has been clocking in at over 10 million shares a day, multiples of its average. This means shares are transferring from weak hands, the frustrated retail investors who just want out, to strong hands who are willing to wait for the 2026 thesis to play out. So what is the actual business here? We need to strip away the AI hype and look at the engine. Rezolve AI isn't building another ChatGPT wrapper. They're building what they call agentic commerce. Most AI today is passive. You ask it a question, it gives you text. Rezolve's Brain Suite is designed to take action. It connects to a retailer's inventory and payment systems so that a consumer can say, find me a blue dress for a summer wedding under $200, and the AI doesn't just show a picture, it finds the item, checks stock, and handles the checkout instantly on a mobile device. This is critical because the friction in mobile commerce is the biggest killer of sales. Cart abandonment rates on mobile are horrendous. Rezolve is trying to fix that by making the transaction instant and conversational. They have over $90 million in annual recurring revenue secured year to date. That is a real number. It's not a projection of what might happen. It's what they have locked in. They are targeting $500 million in ARR by 2026. If they hit that, a $3 stock price is going to look like a mathematical error in hindsight. But we must address the elephant in the room, the trust factor. The CEO, Dan Wagner, is a controversial figure in the tech world. He has had big wins and big losses in the past. This history is why the stock trades at a discount. The market is pricing in a governance discount. Investors are worried about cash burn and dilution. Even though they reported having around $230 million in cash recently, the fear is always, will they need more? The free cash flow is still negative. They're spending money to grow, and in this macroeconomic environment where interest rates are still a concern, Wall Street hates cash-burning companies. That is the anchor dragging ZLV down. Let's talk about the specific price action we saw this week in more detail. On Thursday, when the guidance raise was announced, the stock gapped up. A gap up is usually a bullish signal, but in this bearish trend, it acted as a liquidity trap. Traders who were underwater saw green and sold. This created a fade pattern where the price drifted lower all day. This is classic sell the news behavior, but it's also a sign of a base building. The stock refused to break below the $2.70 support level. It held. This tells me that while there is selling pressure, there is a floor. Someone is defending that $2.70 area aggressively. Now consider the retail versus institutional dynamic on social media. I want you to go onto X, formerly Twitter, or Reddit right now and search for RZLV. You will see a war zone. You have posters claiming the company is a fraud because of the stock drop, which is a common emotional reaction to losing money. But then you have deep dive due diligence posts pointing out the 95% margins and the Google partnership. The frustration you see is real. People are hurting because the stock is down from its highs. But emotional capitulation, when people give up and sell at the bottom, is often the exact moment a stock turns around. We are seeing signs of that capitulation right now. I want to pause here and ask you a question, and I want you to be honest in the comments. When you see a stock drop 50% or 60%, but the revenue goes up 400%, do you see a trap or an opportunity? Comment below with trap or opportunity and tell me why. I really want to gauge where your heads are at with this one. Moving deeper into the analysis, let's look at the macro pressures. The AI sector is crowded. We have NVIDIA, Microsoft, Palantir, the giants sucking up all the oxygen. Small-cap AI stocks like Rezolve are viewed as high beta or high risk. When the Nasdaq wobbles, these stocks get crushed. But when the market rotates, when investors think the big caps are too expensive and start looking for value down the chain, Rezolve is positioned as a prime target. Why? Because it is one of the few small caps with actual enterprise partnerships. The partnership with Google Cloud is particularly interesting. This isn't just Rezolve hosting on Google. This is Google reselling Rezolve's solution to their retail clients to drive Google Cloud consumption. That is a massive distribution channel that Rezolve doesn't have to pay for directly. It leverages Google's sales force. If Google's sales team can push the Brain Suite to even 1% of their retail clients, Rezolve's revenue guidance for 2026 might actually be conservative. But let's play devil's advocate. What if the bears are right? The bear case rests on the idea that the agentic commerce will be slower than expected. Retailers are slow dinosaurs. Integrating new tech takes time. If Rezolve burns through that $230 million cash pile before they hit profitability, they will have to issue more shares. Dilution is the enemy of the shareholder. If they issue more stock at $3, it crushes your value. That is the risk you are taking. You are betting that the revenue ramps up faster than the cash burns down. The technicals on the chart are also painting a very specific picture. We are in a falling wedge pattern on the daily chart, which is typically a bullish reversal pattern, but it needs a catalyst to break out. The earnings report was a fundamental catalyst, but price didn't follow through yet. We need to see a daily close above $3.50 to confirm a reversal. Until then, the stock is technically in a downtrend, regardless of how good the news is. Never fight the trend, but always be prepared for the turn. There is also the short squeeze potential. With short interest in the double digits and a relatively low float compared to the massive volume we've seen, any sustained buying pressure could force shorts to cover. If Rezolve breaks $4, the pain trade for shorts begins. They will be underwater, paying high interest fees, and facing margin calls. This could trigger a cascade of buying that sends the stock vertically higher. This is the scenario the hold camp is betting on. Let's look at the broader sector sentiment. We are seeing a cooling off in the hype AI stocks, companies that just have a .ai domain name but no product. Investors are becoming discerning. They want to see margins. Rezolve posting 95.8% gross margins puts them in the top tier of software efficiency. This metric alone should command a higher valuation multiple. Usually software companies with that margin profile trade at 10 to 15 times revenue. Rezolve is trading at a fraction of that. The market is discounting it heavily because it doesn't trust the sustainability of that growth. So what is the next step for traders watching this one? You need to watch the $2.80 level like a hawk.